The weighted average cost of capital, WACC, represents the overall required rate of return on a firm's invested capital, reflecting the weighted cost of equity and debt in its capital structure. It serves as the discount rate for evaluating investment projects, mergers, and financial performance. Conceptually, WACC is the opportunity cost of funds, balancing investor return expectations with business risk. It is computed as WACC, where E and D represent market values of equity and debt, respectively. V is total capital, E plus D, the cost of equity, KD the cost of debt, and T the corporate tax rate. WACC assumes a constant capital structure and risk profile, serving as the hurdle rate for investment decisions. The use of market values in WACC calculations ensures that weights reflect current investor expectations rather than historical book amounts. Market value-based weighting recognizes that share prices and bond yields fluctuate with market conditions, capturing real-time capital cost implications. If an organization relies heavily on debt financing, WACC decreases initially due to the tax shield from interest deductibility. However, beyond an optimal leverage point, financial risk increases, driving up the cost of both debt and equity as creditors and shareholders demand higher returns for elevated risk. Thus, WACC is a dynamic measure of financial equilibrium rather than a fixed benchmark. To accurately compute WACC, each component's cost must be estimated using appropriate models. The cost of equity can be derived using DVM or CAPM, while the cost of debt is based on the post-tax yield to maturity or loan interest rate. Preference shares, if present, are treated as a separate class of quasi-debt with fixed dividend obligations, added to the weighted formula as KP. The inclusion of convertible instruments requires judgment. Prior to conversion, they are treated as debt, after conversion, as equity. The finance function must ensure consistency in using either nominal or market values for all components, avoiding mixed basis distortions. The interpretation of WACC extends beyond calculation. It serves as the discount rate for net present value, NPV, and internal rate of return, IRR, analyses, guiding investment acceptance or rejection. Projects with expected returns above WACC increase shareholder value, while those below it erode wealth. However, WACC should only be applied to projects with similar risk profiles as the company's average operations. Risk-adjusted WACC variants are used when project risk deviates from corporate norms. For instance, higher-risk ventures may warrant an additional risk premium. Sensitivity analysis and scenario planning ensure robustness of investment decisions under varying cost of capital assumptions. Flotation costs, taxation, and changes in capital structure also affect WACC. Issuing new equity increases costs due to underwriting fees and market signaling effects. Similarly, a change in debt-equity mix alters the marginal cost of capital, influencing investment thresholds. In a multinational context, WACC estimation must incorporate country risk premiums, exchange rate volatility, and differing tax environments. Managers should regularly revisit WACC assumptions, especially in periods of market volatility or strategic restructuring, to ensure it remains representative of the company's true financing cost. In summary, WACC provides a holistic measure of a firm's blended cost of capital, integrating both market risk and financing structure. It acts as a benchmark for evaluating performance, setting return targets, and determining enterprise value. The optimal capital structure minimizes WACC while maximizing firm value, balancing the benefits of debt tax shields against the costs of financial distress. By accurately estimating and applying WACC, management ensures investment discipline, value creation, and capital efficiency. In the broader strategic context, WACC embodies the intersection of finance theory and corporate reality, the quantitative expression of the market's confidence in an organization's risk and return profile.